In this short analysis of meta platforms, also known as Facebook, we from Happy Investors will look at some tools and data sources that you probably do not have access to. Note, this is purely for inspiration, contains no buy or sell advice, only access to paid tools that we use and that you probably do not have access to yourself. Note, this is also purely quantitative, meaning we mainly focus on data and do not look at fundamentals. That means looking at leadership, quality, and intrinsic value. We have not made any calculations for that ourselves. That is, of course, up to you, and this is purely for inspiration. Also, don't forget to visit our website. There you will find free downloads of our stock book and also ETF book with ready-made portfolios, including how to achieve high returns, and check out our analyses as well. For just €99 per year, you gain access to potentially the best growth stocks, value stocks, and dividend stocks, all filtered from our sources, but also our own manual research to determine whether this is a quality company or not. Well, Meta Platforms is of course a high quality company, and at this moment, the stock performs well in the short term, but there may be some uncertainty about its growth potential in the long term, and we will discuss that in this short analysis. First, the fair value estimate is examined from Morningstar. It is set at $560, while the current price is $580. This implies that according to Morningstar's intrinsic valuation, the stock is slightly, but indeed slightly, overvalued. The economic moat is of course strong for this great platform. The Morningstar rating is 3 stars due to an economic moat combined with the fair value at this moment. However, according to Morningstar, this implies that there is no margin of safety and also little upside potential, if, of course, the calculation is correct. Wall Street analysts, and there are quite a few, almost 70, give an average price target of around 640. Well, that is significantly higher than the current price. They also provide estimates of the range, and you see it could potentially be plus 40%. That seems strong to me, but you never know with Mr. Market at this moment. But you also see that the low estimate is minus 55%. So, high uncertainty. Let's take a look at the historical valuation and also the long-term outlook. Then we will zoom in on the short-term based on data-driven tools. First of all, historical valuation. Well, it's very nice to mention that, actually, it's the quote from Charlie Munger. He is just waiting for really big fish, and he is sitting with his spear on the side until such a big, fat fish presents itself, and he can catch it more easily. With the platforms, a great quality company was such a big fish. When the price of earnings had fallen below 10 in 2022, is the market efficient? Here, you see the answer that it is not always efficient. But in the short term, there are of course other factors that come into play, such as Mark Zuckerberg, who invested a lot of money in the metaverse at that time. They also changed the name, yes, and not much has actually come of it. And they took it easy, which caused the earnings to rise significantly again in the short term. Well, the confidence is back, you can see it. And the historical valuation is somewhat in line with both the fair value estimate and the normal multiple. What does that mean? Let's just look at the normal multiple. From Meta Platforms, that normal multiple is of course a bit higher, and over the past 5 years, due to that dip, the average is 23. Well, that seems realistic to me, even for the longer term. The current price earnings are slightly above that. You can see here that the EPS growth estimates are around 11 to 13%. Well, if the PE equals 23. At the end of 2026, that means you could achieve an average return of 7%. But of course, it's not a perfect system. The market also has its ups and downs, so it could be higher, but it could also be significantly lower and even incur temporary losses. If you look at the long-term growth estimates, then about 10 analysts provide an estimate of the long-term EPS growth. And what stands out here is that it is only 3.75% EPS growth per year. Honestly, I have no idea why this estimate is so low for Meta Platforms. But what does that mean? Because the current price to earnings is already on the higher side, and that EPS growth estimate for the long term is relatively low. Yes, let's say that the normal multiple of Meta in the long term is 21. To keep it simple and within this data system, then we see that the average annual regulation is actually a total of minus 30% in the very long term. Whether that is really the case, no idea. Only Meta Platforms is of course a very large company, and they obviously just have to keep growing and growing. Logically, the bigger you are, the harder it is to achieve interesting growth. But yes, if you have a lot of cash and a good, profitable acquisition strategy, you can go very far. So, everything obviously depends on your own assessments of this company. Looking at the factor analysis, we see that the valuation grade is a D. However, this is of course based on relative valuation, and that is very important. And Meta is in the interactive media industry. It has a sector median that is lower in terms of PI ratio. And at this moment, Meta's forward PI ratio is estimated at 25-26. Not extremely high, but slightly above the normally a multiple. And normally I say that yes, a solid company has a multiple of 15. PI equals 15. But a strong company like Meta might have 20 or maybe even higher. And temporarily it can be much higher. So it doesn't seem extreme yet. That in comparison to, for example, extreme examples like Nvidia or other similar companies, it all seems quite reasonable for Meta, and also Meta's growth figures are quite impressive. You see, the EBITDA growth is estimated at 30% for next year. The EPS growth is also estimated at an attractive 20% for the next 3 to 5 years. This is, by the way, a deviation from our estimates at Fastcrafts. So we combine multiple tools to just get a feel, only from our analyses that we publish monthly. We mainly look at smaller, relatively smaller companies with a much smaller market cap. Firstly, because those companies can grow much easier and faster. As a result, you have much quicker multi-baggers that double, quintuple, or even decuple. And we have quite a few examples that you can find on our website from our analyses. But also simply because the market is often more inefficient with smaller companies. This also means that you can often miss out because smaller companies naturally also carry more risk. For example, look at Meta. Based on profitability, extremely good. Return on equity of 36%. Very high. Net margin has recovered and is above 30%. So yes. You always see that during major stock market crashes and economic uncertainties, companies with very strong profitability often thrive. However, the valuation of Meta is not super cheap. So, upward potential may be low while downward potential is plausible. ZexRank gives a buy signal based on their analysis, and their price target is $600 per share. That is lower than what most Wall Street analysts think, and the price target means a small upward potential in the short term. Whether it is so, time will tell. You also see the consensus estimate that the current price is above that. That is actually never favorable. There are reasons to invest, but there are also reasons to sell. Purely based on technical analysis, you can't say much except that Meta is still in a buy signal territory. At the moment, a new all-time high has been formed. And yes, the market may continue to push forward for a while, despite the sky-high price-to-earnings ratios of the S&P 500. But you also see that even great companies like Meta or other types of great companies can sometimes face challenges, and then it can go down hard, especially when concern and fear increase. You can see it here. Meta was down 72% from 2021 to 2022. Gigantic. And what happens in this long, really long period? More and more bad news keeps coming. And then you start reading analyses about how bad things are going for companies and that the end is in sight. But the market is often wrong. They are often right more than wrong, but they don't always get it right. And the value investor simply waits very patiently for great companies to end up in bad weather with huge price volatility and take advantage of that. So it's up to you. I'm curious about what you think of Meta platforms. Let me know, and thank you for watching.